To cut or not to cut? That is the question. The market seems to have made its call. Is it right? Let's ask Robert Kaplan. He's the former Dallas Fed president, vice chairman at Goldman Sachs, and he is here at Post 9. It's nice to see you.
Good to see you, sir.
I noted you avoided the incoming today in the presidential missive at Goldman Sachs. Congratulations. He wants cuts. He's made that clear. Rick Reeder sat with me not 15, 20 minutes ago and said Fed should cut. Way too restrictive. You don't sound like you're that sold.
I'd be leaning toward cutting in September if I were in my former seat. The part that I'm sort of the cross currents I'm weighing, weak job market, and you've heard me say before, the headline unemployment rate masks a weaker job market than appears, and the reason unemployment's so low is just lack of supply, but hiring is down to stall speed. That would move me toward wanting to cut. Also, you've got some disinflationary forces. The AI boom, big overcapacity in goods, which I think was reflected today in the CPI. Mm-hmm. You got sluggish demand, and so all that makes me lean to cut.
Why not? Why just lean? You paint a scenario in which you'd be like falling over to cut.
Here's the only thing I want to understand, and this is a sensitive topic, but I want to understand is we are not through the setting of the tariffs. I think it's easier for businesses to process low to mid-teens, a little harder to process high teens. It's going to get divvied up among suppliers, maybe a stronger dollar, maybe some margin erosion, maybe some in pricing. I don't know how it's going to be split. And at the Fed, if you don't need to jump into that risk, we'll know a year from now how it was split. And so the weaker job market would push me to act. But if it weren't for that, I might want to be patient.
Would you admit that the tariff sky is falling calls that have been out there from people, that it's going to cause this inflation, that it hasn't materialized in a meaningful way to this point?
I do agree with that. And I've been saying for quite some time, we're in a world of manufacturing and goods overcapacity. The inflation issue in the United States, and this morning confirmed it, has not been a goods issue, it's been a services issue. So yes, in that context, it makes me feel more confident that maybe after these tariffs get set, over the next year, we'll realize it's a one-time price effect, not persistent.
It sounded like the Kansas City Fed pres today was hold. I mean, how, in your environment, the one that you see, how can anybody be a firm hold? Let's not raise rates, not cut rates right now.
The argument around the table for not cutting is the job market is still, what they're being swayed by is a headline unemployment rate of 4.2. They're saying, yeah, hiring is sluggish, but we're in balance and we still are above target on inflation. My counter argument to that would be, I think the hiring market is much weaker and the job market is much weaker. You have to look more broadly than headline. But those that will counter argue are saying, we're still at full employment, you should be more patient.
Okay, so you've stated your position that you're leaning, if you were in your former seat.
I'd be inclined to cut.
Okay, what will they do? What will they do in September?
I think they will ultimately cut in September. The only thing that could derail it is if you got a surprise in the job report early September. I don't expect that. The part that may disappoint people, this, in my opinion, is not the start of a cutting cycle. It is, we'll cut in September, and then you wipe the slate clean and take another 6 weeks to assess these cross currents, make a new decision in October, and a new decision, or October, November, and a new decision in December. I think the markets have gotten ahead of that and are saying it's much more likely they're going to cut 2 or 3 times. And I don't think it's as clear as that. They may wind up doing it, but they're going to have to feel their way through it.
You think it could really be a 25 one and done for a while?
The only reason why it would be if you saw that the weakness in the job market was overstated. I don't think that's going to happen. Then they'll have to assess that for November. But is it whether it's going to be 3? I think it's more likely to be 2 than 3, for example. But I don't know, and so we're going to have to see. Now, one other comment I would make: a lot of people say, "Well, look at last fall. They cut 50 in September. I wouldn't have done the last 25 in December, but they did 100 basis points. But the difference was a year ago we were at 5.25, 5.5. We had a lot more room. In my opinion, at 4.25, 4.5, I think you can cut down to 3.25, 3.50. But I don't think there's a lot more room to cut than that. And why do I say that? I think the inflation rate's around 2.5, 2 3/4, and the real Fed funds rate, in my opinion, is 3/4. So I think you got 75 to 100 basis points of room, whereas a year ago, I think you had more like 175, 200 basis points of room.
Who would be the best next chair of the Fed in your mind? Because the pool's getting bigger.
I think any number of the candidates who've been talked about. The key for the next chair, they have to have strong economic views on their own 2 feet. They have to command the respect of the room. They have to be good at assembling a consensus. And I do believe they have to demonstrate they can throw in new ideas, out-of-the-box ideas, but they have to be committed to the ethic of the Fed, which is independence from political influence and political considerations.
They have, but that's your own point of view. They have to.
That is my point of view.
Because the president and other people around him may have a different idea. They may.
So you asked my opinion.
Yeah.
So that was my opinion. My opinion is I think the country would be best served and all parties would be best served by someone who fit those characteristics.